A company may have billions of dollars in assets, but it can still go bankrupt. How? Answer: liquidity. Liquidity refers to the ease with which an asset can be quickly converted into cash. In other words, it shows how quickly you can start using your money. It's like finding water when you're thirsty. It's not just about having the water, it's about being able to get to it immediately. Think about it. You have a world-famous painting worth $100 million. On paper, you're rich. People think you're enjoying yourself on a luxury yacht. But if it takes months or even years to sell that painting, if you don't have cash in your pocket that you can use in an emergency, you've failed miserably and haven't fully grasped the concept of liquidity. That cash you can access at any time in the bank? That's what high liquidity means. Moreover, this concept isn't just about artworks. When you buy a new iPhone, your old case doesn't fit. Then you need AirPods, a new charger, maybe a MagSafe wallet, and suddenly a phone turns into hundreds of dollars in expenses. You have the phone, the headphones, the super expensive shoes, but you don't even have $20 left in your pocket to buy a Big Mac. In short, you're weak in cash. The same thing happens in finance. You have assets, but if you can't convert them into cash immediately, a chain reaction of problems begins. And no one really wants to be in that situation. For example, companies with high liquidity can pay their debts in times of crisis because they can quickly sell their assets and convert them into cash. Those with low liquidity, on the other hand, risk going under when cash flow dries up. That's why professional investors look not only at a company's profit margins, but also at its liquidity ratios. And this way, they usually come out ahead in the short or long term. From Wall Street to the London Stock Exchange, everyone pays close attention to these ratios in company reports. Because liquidity is one of the biggest precautions a company can take against crises. Brands also use this for their own ecosystems. Apple, Samsung, IKEA. They all work to ensure that one product complements another. Finance works the same way. One flaw can affect the entire system. For example, during the 2008 global financial crisis, many giant companies appeared profitable on paper, but they collapsed within days because they had no cash on hand. Real estate, investment funds, stocks. They had assets, yes, but there was no time to sell them. High liquidity is what saves lives at this very point. Now ask yourself, do you only have assets, or do you also have the liquidity power to use them quickly when needed? Because in the financial world, this is the key to survival. We've covered liquidity. Next up is volatility. If you want to learn the language of the financial world, subscribe and turn on notifications.